The Cato Institute hosted a forum on tax reform on Capitol Hill. Panelists from Americans for Tax Reform, the American Enterprise Institute, and the Cato Institute discussed the prospects for a Republican tax reform bill. This is an hour.
Alrighty, I think we're going to get started here. I want to welcome you all today. I am Peter Russo. I'm the Director of Congressional Affairs at the Cato Institute, and I want to thank you all for coming today. This is a Capitol Hill briefing entitled The Home Stretch for Major Tax Reform. And of course, we crossed a big hurdle today in the House as they agreed to the Senate budget proposal, which of course paves the way for a reconciliation-derived tax reform package. This spring, the Cato Institute released the 8th edition of the Cato Handbook for Policymakers. Copies were available on the table as you came in, and our recommendations for tax reform begin on page 45 of that publication. And further, there are 4 other chapters that deal exclusively with fiscal policy. If you'd like more copies, please contact me after the program. Meanwhile, fully searchable PDFs of the entire 80-chapter volume are available at cato.org. With that, I'd like to introduce Ryan Bourne, who occupies the R. Evan Scharf Chair for the Public Understanding of Economics at Cato. He has written on a number of economic issues, including fiscal policy, inequality, minimum wages, and rent control. Before joining Cato, Bourne was head of public policy at the Institute of Economic Affairs and head of economic research at the Center for Policy Studies, both of which are in the UK. Bourne has extensive broadcast and print media experience and has appeared on BBC News, CNN, and Sky News. And he also writes weekly columns for both the Daily Telegraph and the London paper City AM. He holds a PA and a Master of Philosophy in Economics from the University of Cambridge, United Kingdom. And we will leave time at the end for Q&A, and I'll have a short announcement before we leave. But for now, let's please welcome Ryan Bourne.
Well, good afternoon, and thank you so much for all being here today. I think the size of the audience is both testament to the importance of the topic and also to the quality of our speakers on the panel, so welcome. The title today asks us whether this is the home stretch for major tax reform. And it really does feel as if momentum has been building in recent weeks, particularly with the Senate budget agreement obviously now passing the House today too. Major tax reform has been something talked about for decades. And I think the ambition of the plans and the frameworks being laid out are exciting, not just for those of us who spend our lives analysing these things, but also, I suspect, for ordinary voters, workers and businesses who have waited for this kind of agenda. Nevertheless, it's fair to say a multitude of questions remain. The factual ones will get hammered out in the coming weeks. How far will the corporate tax rate be cut? What will the top marginal income tax rate be? What will happen to base broadening measures like with the state and local income tax deduction? But there are also the contestable ones related to analysis of the plans. What will be the impact on economic growth? What will be any static or dynamic revenue losses? And how far will corporate rate cuts feed through into higher wages? With all these debates still rumbling, you wonder whether, to quote Winston Churchill, we are at the beginning of the end or merely the end of the beginning. To navigate some of these questions, we have a real expert panel today. Before I introduce them, though, it's worth noting one bad argument that opponents of the tax plan have been propagating, and that's to distinguish between tax cuts on the one hand and tax reform as this some kind of purer revenue-neutral concept on the other. Economists would say that cuts to taxes that make codes more economically neutral actually constitute reform in and of themselves. So, of course, can eliminating deductions, which would raise taxes on net. But it's fair to say when you look around the world at successful tax reform, without net tax cuts, reform becomes that bit more difficult. And that's because if you have no net tax cuts, too many people are identified as losers, making it politically very difficult to get changes through. A line that really stuck with me when we were discussing these issues in the UK a few years ago that sums up this sentiment is that tax reform without tax cuts is politically suicidal, but tax cuts without reform is a huge missed opportunity. So we have 3 great speakers today to discuss all these issues, and they'll speak in the order in which I introduce them now. First, Grover Norquist, is the founder and president of Americans for Tax Reform. Grover has been at the forefront of the tax cut movement for decades and is the chief promoter of the Taxpayer Protection Pledge, signed by lawmakers to oppose increases in marginal income tax rates for individuals and businesses, as well as net reductions or eliminations of deductions and credits without matching reduced tax rates. He was one of the co-authors of the 1994 Contract with America and has been described as the high priest of Republican tax cutting by the New York Times. Second, Alex Brill is a resident fellow at the American Enterprise Institute. Alex is the author of numerous studies, including a pro-growth proposal to reduce the corporate tax rate to 25%, and is also the author of The Real Tax Burden, More Than Dollars and Cents. Before joining AEI, Alex served as the policy director and chief economist of the House Ways and Means Committee. He's been on the staff of the White House Council of Economic Advisors and also on the staff of the Simpson-Bowles Commission. Finally, Cato's own Chris Edwards is the director of tax policy at Cato and editor of downsizinggovernment.org. Before joining Cato, Chris was a senior economist on the Congressional Joint Economic Committee and an economist with the Tax Foundation. He's the author of Downsizing the Federal Government and co-author of Global Tax Revolution. So each speaker will speak for about 10 minutes in the order that I've introduced them. Then we'll leave plenty of time for questions from the floor at the end. So, Grover, over to you.
Thank you. Thank you. Step one, tax reform, tax cut. The answer is yes. I think you quite correctly said it's both. The people who try and suggest there are two things there miss the point. Where are we trying to get to? I would argue that the tax reform is, as outlined right now, is significant progress, and two, going to pass. Step one, where are we trying to get to? How do we know it's significant progress? Where are we trying to get to? I would argue that we want to get to taxing income one time at one rate. The reason you want to move towards taxing income at one rate is not a question of fairness. Taxation is taking money from people who earned it and giving it to people who didn't necessarily earn it. Fairness is not part of that equation. You can do it in more or less destructive ways, but fairness is not the issue. The reason you want to have a move towards a single rate tax is because then the politicians have to look everybody in the eye when they want to raise taxes and say, I've got a really good idea, and you're all paying for it. Prior to emigrating to the United States, I grew up in Massachusetts, and there we have, by Constitution, a single rate tax. They have an income tax, has to be single rate. 5 times they put on the ballot, let's go to a graduated income tax. 5 times, Blue Massachusetts, George McGovern, Ted Kennedy, Massachusetts, has voted that down on the basis that, yeah, year one, you'll raise taxes on the Kennedy kids, but year 2, 3, and 4, you'll come for the rest of us, and the Kennedy kids won't care what happens to us anymore. And if you don't have a single rate tax, you have what we've had for years, which is the Richard Speck theory of tax increases, which is if you can't take on everyone in the room, you take them out of the room one at a time. Just the 1%, just the smokers, just pick people in groups and then take them out and mug them outside. Taxing income one time, we have the problem now that we tax it when you earn it, when you save it, when you invest it. If you put it in a company, if you get a capital gains, you're stupid enough to die, they want to take almost half. So they keep coming back for the same bite at the apple. Part of what we're doing here is taking rates down, which gets you towards a single tax, single rate tax, and by not having a death tax and making some more savings tax-free, we move towards taxing income one time. Is this the end of the game? Is this, we pass this and then we win? One of the things that I found most disappointing about the conversations we've had on this so far is this conversation that this is a once-in-a-lifetime historic event. What does that mean? Well, we haven't done fundamental tax reform since 1986, and so that's been 30 years. It implies that we're going to be another 30 years before we do this again, which means everybody who runs a trade association or is a small businessman or whatever goes, I'll be dead or retired by the time we revisit this. Therefore, I had better get the thing that matters most to me into this bill or sink it, because if I don't get this done now, I'll never see an opportunity to do it. If there's one plane out of Casablanca, there are very sharp elbows of all the people who want to get in the plane. If there's a bus every 20 minutes, you let the little old lady in the wheelchair go because you can come back. The good news is that I've had a direct conversation with both Paul Ryan and Chairman Brady, as well as Vice President Pence, and said, just this point, could we work on not calling this a once-in-a-lifetime thing in the sense of not again for 30 years? And they said, no, as long as there's a Republican House and Senate president, we'll get a tax cut every year. We did under Bush. Some of them were big, some of them were small. But when he had a Republican House, Senate president, we had a tax cut every one of those years, and that will be the case now. I think it's important for all of us to make that clear to the American people, that this is going to be a significant tax cut, significant tax reform, but there are a lot of things that are going to be left off the table. While we're going to go to a territorial tax system for businesses, we are not going to a territorial tax system for people. We have 5.5 million Americans who live and work overseas. We have 10 million Americans who live overseas, 5.5 million who work and vote, or could vote because they're the right age. I do wish also that when we talked about Americans with jobs, we don't talk about bringing in, we've got to bring these American jobs back here. We want to have jobs in America. We want jobs for Americans. That includes 5 million plus people who happen to be working in Hong Kong or Britain or some other country. And right now we tax them. We let the Europeans tax them, and then we tax them again, just as we do with companies. Everybody's agreed it's a very stupid, destructive thing to do to American companies. It's also a stupid, destructive thing to do to people. And so companies overseas are hiring somebody from other countries rather than Americans because our tax system makes hiring Americans more expensive. Why is this going to pass? Didn't we just have a big blow up the other day, and the president and 2 senators were throwing spitballs at each other, and doesn't that endanger this project? Well, 2 thoughts. Flake and Corker have, if not 100% votes with the rest of the modern Republican Party and Trump, close to 100%. They're both grown-ups. They're committed to tax reform. They've each played a role in this bill in terms of shaping it and so on. That I do not believe that brouhaha, the shiny thing that attracts folks on cable television, suggests anything about how people will vote on tax reform. We've seen it come through the House. In the Senate vote was everybody except Rand Paul, and he had a particular point he was trying to make, and he made it, and the next day he tweeted, "I'm all in for tax reform." So that vote of his was not a vote endangering tax reform. It was a vote because he wanted something on spending. He wanted some focus on an issue. I think he got some of what he wanted, but not all. But it was not an effort to hold tax reform hostage or to endanger tax reform. So we have 52 votes. You can still have 2 people wander off on voting day, but we have a solid Republican agreement. We saw the people who voted today were the folks who like to throw up votes so they can get on talk radio and tell everybody that this didn't solve all the world's problems last Tuesday. So I had to vote no and let everybody know, in case you weren't aware of that. This is not a part of the caucus that endangers reform of health care. Why are we here with the Republicans? I would argue that the issue that divides the 2 parties more than any other is the tax issue. There isn't a Republican in the House and the Senate who won't cut your taxes. There isn't a Democrat in the House or the Senate who won't raise your taxes. It is the issue that you have the least amount of crossover. There are a few Democrats who won't steal your guns. There are a few Democrats who are social conservatives. There are no Democrats who will not raise your taxes every time they have a shot at it. And there are no Republicans against cutting people's taxes as we move forward. Of all the things that have divided the 2 parties out, we used to be the North and South Party. If somebody was a Republican, you knew he was born north of the Mason-Dixon line, but that's all you knew about him 50, 60 years ago, okay? Today, somebody tells you, and then the little old lady in Mississippi who agreed with Ronald Reagan on everything and voted for George McGovern because Sherman had been mean to Atlanta recently. Those people have moved on, passed away, or switched parties. So we have 2 rational parties on questions of size of government. The other thing that we helped a little bit with the Taxpayer Protection Pledge, where we asked all the candidates, almost all the Republicans, about 90+% of the Republicans in the House and Senate have taken and kept the pledge. The only pledge breakers were in 1990. Remember Bush, George Herbert Walker Bush, got some people to agree with him to raise taxes in 90 so we could stop the Reagan period of uninterrupted growth and elect a Democrat, which worked. if that's what he was trying to do. He reminds us with his tax increase that no one's life is a complete waste. Some people serve as bad examples. Don't do that. It didn't work. Big mistake. And the modern Republican Party watched a president who was actually otherwise very successful, managed the collapse of the Soviet Union, kicked Iraq out of Kuwait without getting stuck occupying the place for 20 years. He did pretty well. One problem, tax increase. And he lost the presidency as a result. Since then, we've had pretty close to ivory soap percentages of Republicans committing not that they'll never raise taxes and keeping that commitment. Everybody who voted wrong in '90 is dead or retired. There are none of those people in the House or the Senate anymore. So this is progress. It's moving in the right direction. You have a unified Republican Party. There'll be lots of discussion between now and then. But the reason why things will be able to be settled is not only the unity on the pledge. And Republicans understand that they have branded their party as the party that will not raise your taxes and that supports tax cuts. Coca-Cola spends a great deal of time working on its brand and quality control, so you can go to the store, buy a Coke, take it home. You don't have to read the ingredients. You don't have to ask your friends what it tastes like. You don't have to ask the proprietor, could I take a taste and see what this is before I take it home? You know what's inside it. You get it home. But if you got your bottle of Coke home and you look down and when you were 2/3 through the bottle of Coke, you noticed that there was a rat head in the remaining third, you would not say to yourself, you know, I'm thinking I won't finish the rest of this bottle right now. You would, in fact, wonder whether you'd buy Coke in the future, and you'd go on, take a selfie with this, and Coca-Cola would have a big problem because it would damage the brand for all Coke bottles, not just the one that was a problem. And Republican elected officials who vote for tax increases are rat heads in a Coke bottle. They damage the brand for everyone, so these self-police, they confuse small children about the nature of the world. You know, Mom, you said, and right there I see. So this, moving the two parties in two separate directions has made it difficult to cut taxes when the Democrats are in charge, but much easier to cut taxes when the Republican Party is in charge. And let me end with the following thought. We're going to have a tax cut every year that the Republicans have the House, Senate, and the presidency. This means anything that doesn't get into this package is not lost for 30 years. It makes it easier to vote for an incomplete bill that doesn't cut rates enough, that doesn't do enough for Americans or businesses that live overseas, that doesn't do enough to reduce the cost on savings and investment. And you make a list of the things that aren't in this bill. That's the list of our next targets. That is not the list of disappointments. That is the list of things we will do next year or the year after. And I would suggest to those trade associations and companies and industries that say, well, I didn't get enough out of this. If you help get this across the finish line, you could be at the beginning of the line when we make the next tax bill next year and the year after that. If, however, you whine and kick people in the shins, you are at the end of the line when we solve other people's problems going along. I believe that will make it easier, both for congressmen, senators, and interested parties to be supportive of a bill that does many, many good things, but not everything, okay? I mean, the IRS is still there at the end of this process. So with that, it's tremendous step forward. It's tremendous progress. Politically, it will pass because the brouhaha that the press likes to focus on does not endanger general votes. I mean, after all that stuff where people were pushing and throwing spitballs at each other the other day, the Senate went out and voted to pass a Congressional Review Act to go after the trial lawyers, to defund the trial lawyers, which the trial lawyers say is, you know, they were anti-consumer. So you had a united Republican Party sitting around and voting, Flake, McCain, Corker, everybody, just after this sort of dust-up. And the press covered the dust-up and missed the dramatic CRA that overrode the Dodd-Frank regulation that had been in, and we now took it out. So just an example, within hours of the dust-up, it affected nobody's vote. We lost 2 people because the trial lawyers have a lease on them. Not ownership, perhaps, but you were going to lose those anyway, whether they were best friends with the president or not, because of their relationship with the trial lawyers. So cheerful news, going to pass. I think some people will make a case as to all the cool things it'll do for the economy, but I think that lower marginal tax rates on capital and labor is self-evidently good for the country. Thanks.
Thanks very much. We're off to a good start. Grover had a lot of great insights, and I'd like to associate myself with his optimism. If I can't replicate his passion, I am optimistic that we're going to have a tax bill. I think that I'm hopeful that the folks in the room here are optimistic. That's why they're here. It's not just for the free food. They're here because I hope you're here because you believe that there will be a tax bill, and you want to know more about it and what it might look like or what it should try to look like. I want to try to touch on a few issues sort of generally about what tax reform is or can be or should be, and then I'll try to touch on some of the economics, and particularly the economics around corporate tax cuts and corporate tax reform. So first, an issue that the past few speakers have already addressed, this question of what tax cuts versus tax reform, which is which, why are we calling this reform, why did we call the other bills during the Bush era tax cuts, are we for one or are we for the other, what's going to happen? So the first key, and this is I think consistent with what Grover was saying, is it's not a binary choice, right? And so if you ask academics, not politicians, but academics who study tax policy, what is tax reform? Generally, the answer is it is moving from the tax code we have to one where we get the same amount of revenue in a better way, right? So instead of doing it in a way that hurts the economy, let's try to figure out how to collect the revenues that we need in a way that doesn't hurt or that hurts less. And that often involves, first and foremost, lower tax rates. And I think that if you think about how to message some of these issues, we've heard over the last year or so, as this debate has really heated up, folks talking about that concept. And oftentimes the way that's messaged is people say, I'm for tax reform, I want to cut taxes, I want to cut tax rates, and I want to close loopholes. And I think if you say it that way, it sounds pretty good, I think, because people aren't really in favor of tax loopholes. There's another way to say the same thing, which is maybe a little bit wonkier, which is I want to cut taxes, I want to cut tax rates, and I want to broaden the tax base. And I think if you say that to a broad audience of constituents, that actually might also go over okay. And the reason I think it'll go over okay is because nobody knows what broadening the tax base means. So they understand what tax cuts and lower rates are, and then there's this other thing that kind of doesn't really offend them. So they're still sort of relatively excited. But I'll tell you, if you tell people that you want to cut taxes, you want to lower tax rates, and you want to raise taxes also at the same time, well, that doesn't go over well at all, right? And that's the winners and losers problem that was mentioned in the introduction, and that's some of the challenges the politicians face. So cutting tax rates and also creating lots of winners is tough politics, and I think that there's plenty of evidence of that. But it's not a binary choice, and we saw that play out in the budget resolution, and we've seen that play out in the sort of the core outline, the Big Six plan that Republican leaders have introduced. They are talking about cutting taxes. They are talking about cutting tax rates. And they are talking about some base broadeners, like doing some things to repeal some deductions, to repeal some credits. And there's a good reason for that. And I just want to speak for a moment in defense of some of these base broadeners, some of these repeal of these special provisions in the code, is because those provisions are distortionary. They're bad economics. They make people make choices that they wouldn't otherwise make. And I don't mean to say that there isn't one that's not defensible, but I mean that if we use the tax code as a tool where lawmakers are deciding how to, over and over and over again, how to push or pull taxpayers into making different decisions, then we end up with a system that is full of holes and subsequently very high tax rates. And those tax rates are bad, and those distortions are oftentimes bad as well. And so the tax reform is about going back to the broader base, taxing, Grover says tax everything once. I completely agree. That means everything. Tax it just once, but tax everything once. And let's move in that direction. And what we saw in the budget resolution is an effort to reduce taxes over the next decade by $1.5 trillion. But what we know from the talking points or from the proposals as they've been described so far is it also talks about having a system that's a little bit simpler with a bit of a broader base. And we get simpler by doing things like doubling the standard deduction, by repealing the state and local tax deduction. We get some fairness, and then we can get more tax cuts as we have those offsets. When you add it together, it looks like it's going to be a net tax reduction that's going to afford more tax cuts overall. I want to focus in on one aspect of the tax reform, which is what's happening on the business side. Now, folks who play in this space know that most of the revenues that are raised from the tax code come from individuals. They come, payroll tax obviously is a huge tax, but the ordinary income tax is where we get most of our revenues. It's from taxing wages, from taxing workers, from taxing households. But about 10% of the revenues come from corporations. And which taxes to cut first and which tax cuts yield the most benefit, we don't know that by looking at where we get the revenue. We know that by looking at sort of the economics underlying the consequences. And that's easy to understand because, as someone said I think in the Wall Street Journal yesterday, if we had $1 million tax on airline flights, we would have no airline flights, but that doesn't mean the tax isn't distortionary. And so on the corporate side, this is the tax that I think is the most distortionary. And I think that probably everyone in this room who follows tax policy at all knows two things about the corporate tax code. And I'm going to repeat them one more time, and everyone knows what they are before I say them. We have the highest tax rate in the industrialized world, right? We've had it. Everyone else has cut their rate. Ours is 35% plus the state tax. We have the highest rate in the world. And as a consequence, our business tax system, our corporate tax system, is not competitive with our competitors. Right? Everyone's heard that so many times. For a decade, there's been a campaign, at least a campaign to cut the corporate tax rate. And those are the two arguments. First, ours is the worst, and second, it's hurting our competitiveness. But the problem is so what? What does that mean, right? No one's made the case for why I, as a worker, should care so much that the CEO of Ford has to sit on top of a company where he's the CEO of a company and paying a tax system that's less competitive than the CEO of BMW. What does it matter to me, right? And so we've heard so much about this rhetoric about how our code is the worst, but we don't pay that tax, right? We don't pay the corporate tax, we pay the individual income tax. We're the voters. And so what we haven't heard in the last decade is a strong argument about why I should care about those facts. Those facts are true, but no one has done a very good job convincing us why that matters. Until a couple of weeks ago, quite frankly. A couple of weeks ago, the argument started to shift, and it became an argument unto itself. It became a debate and became, I won't say a scandal, but in the economics community, there's a sort of big argument going on right now about why we should care. And the issue is this. We know that corporations they collect the tax, but there's a consequence to someone else in the economy as a result of that tax. And broadly speaking, it could be the guys that own the business, or it could be the guys that work at the business. And the question is who's the loser when we have the worst corporate tax rate? And I'll tell you, for a long time, economists, there was sort of a consensus. There was sort of an agreement across the political spectrum. This goes back, decades ago, but decades ago there was sort of a consensus among liberal and conservative economists that there was the shareholders, that the owners of the business were the ones who sort of bore the brunt of the corporate income tax. And then some people started to revisit that question and look again at the evidence and recognize that the economy today is different than the economy of 20, 30, or 50 years ago, and that this incidence, this burden, may be different as well. And the reason why there was a consensus, and quite frankly, it might have been true in the past, the reason that where that consensus came from was a view of the economy that was relatively simple. And the view of that economy in the old world was that the economy is generally closed, meaning not open to trade, and that the amount of capital in the economy is relatively fixed. And so if you're taxing capital, then if you own it, you bear the brunt of that tax. But other than that, it doesn't really matter because it's just kind of a fixed thing. Well, that's actually not how the economy works today. Today, the economy is much more open than it was 30 or 40 or 50 years ago. And there isn't a limited supply of capital in the United States. there's kind of an infinite amount of capital. Now, not literally an infinite amount of capital, but we do know that when business opportunities are good in one country, whether it be Ireland or Malaysia or the Netherlands or France or Germany or wherever, or Mexico or Canada, people take their money and they go to that place, right? They build factories there. They hire workers there. And that's not the United States today. And so the principle behind corporate tax reform, why it's important, is because it will bring activity here. And is the first thing. And the second thing is it'll bring reported profits here as well. And we are in a very dynamic global economy today. We haven't closed off our economy yet to the rest of the world, although sometimes we threaten, some of us have threatened to. We have a relatively open economy, and when the corporate tax rates change dramatically, we will see businesses respond dramatically. We will see profits shifting back into the United States, and we will see an increase in real investment in the United States. The consequence of that change in real investment in the United States will have consequences for the workers. Will have consequences for the people who work in those factories, who work at those businesses. Their wages will benefit, right? And it is not a complicated economic model to suggest that. It's a relatively simple model. It's just one that is an open economy model, and we can get those effects. And so the Council of Economic Advisors estimated that effect could be as much as $4,000 per household. Other people have estimates. I don't want to sort of endorse any one of these numbers. The Tax Foundation was out today saying that the number might be $1,800. Others have other estimates. Larry Kotlikoff had one in the Wall Street Journal a few weeks ago. And to be honest, it's hard to know. It's hard to know because we haven't done this in a long time. But this is an experiment worth trying, because we know theoretically, and we know from the experiences of other countries, that when other countries have done this, and when we understand that the economy is relatively open, we understand that wages are going to go up. Exactly how much? We're going to find out after we do it, right? But we know directionally that the economy is going to be better off, and that doesn't mean that the shareholders are going to be the only ones who are better off. It means it's the workers who are going to be the ones who are better off. There's a lot of chatter. There's the last point I'll make, and then I'll pass the mic. There's been a lot of chatter not only about the wage question, which I think is fantastic to be having this debate, and let's argue about whether it's $1,800 or $4,000 or some other number, but we know that it's a positive number. There's also been a lot of chatter about the economic growth overall, the GDP effects. And here, too, I think that we should be confident that if we can bring the rates down, and we have to be cognizant in this context of the net budget impact, whether it's the net revenue impact or the net deficit impact. But we can have a tax reform that is net positive for the overall economy. What that means is that we will, with a better system, one different from the system we have today, the size of the U.S. economy will be larger than it otherwise would be. It will take time from the day of enactment to the day that effect is fully realized. And during that period of time, the economy will grow faster, and then it will reach this new higher level that it otherwise wouldn't reach, and we will all be better off as a result of that. Sometimes people claim that we might get 10% growth or something like that, and I think that would be misleading, but I absolutely believe that we can see faster economic growth in the near term and the medium term, and good tax reform that's fiscally responsible and brings down these marginal rates, particularly this most important reform, the business reforms that bring a corporate rate that makes us lower than many of our competitors, not on par, but lower than many of our competitors, will bring in a lot of revenue. And in fact, that dynamic score of that corporate change, I think, is something that we should be thinking a lot about. There's a good chance that we will have so much onshoring of corporate profits that we'll be losing far less revenue than would otherwise be suggested by the sort of conventional models from CBO and joint tax. So I share the optimism. In terms of timing, I think it will take a little bit of time. I don't think this is something that's going to wrap up before Christmas, but I think that doesn't really matter from an economic perspective. I think lawmakers are going to get this done early next year, and I think there are going to be benefits as a result of it. Thank you.
Thank you, Alex and Grover, and thank you all for being here. I'm going to talk about individual tax changes. Alex mainly talked about the business end of it. The main thrust of the Republican plan on the individual side is to lower marginal tax rates. Why do we want lower marginal tax rates? Well, lower rates encourage people to do productive things like working and saving, and it discourages them from doing unproductive things like tax avoidance and evasion. Cutting the top tax rates is particularly important. Ronald Reagan slashed the top individual tax rate back in '81 from 70 to 50%, and then the rate dropped further in 1986 to just 28%. The 1986 Tax Reform Act was kind of remarkable. You go back and look at the vote count. There was large bipartisan majorities in both House and Senate back in 1986 to drop the top personal rate to just 28%. It's kind of remarkable. Today, the top rate is at 40%. Republicans are talking about dropping it to 35%, which would be progress. So why is cutting top rates so important? Let me get a little bit wonky with you. Economic distortions rise rapidly as marginal tax rates rise. Economist Greg Mankiw said, quote, "It is a standard proposition in economics that the deadweight loss of a tax rises with the square of the tax rate. If we double a tax, the deadweight loss increases fourfold. A 40% tax rate is 4 times more damaging than a 20% tax rate." So it's basic economic theory that the damage from high tax rates is particularly troubling for the economy. Also, high earners tend to be very dynamic with their earning and investing behavior. They have more flexibility than other taxpayers. You get the biggest bang for the buck in tax cuts when there are strong behavioral responses, and studies find that high earners have the strongest behavior responses to tax changes. It's also true, and this is more of an opinion, that people at the top end are highly productive. It's true that in the top ends of the tax distribution, you get a lot of Hollywood people and people like Kim Kardashian and people like that. However, the bulk of people at the top end, they're entrepreneurs, they're venture capitalists, they're doctors, they're brain surgeons, they're corporate executives. These folks are very important to the economy. It would do more for economic growth to cut their taxes than to cut the taxes of a wage earner like me. For these reasons, countries around the world have slashed personal income tax rates in the last few decades. Alex talked about how corporate tax rates have fallen. It's also true for individual rates. Back in the mid-1980s, the average top rate in the OECD countries for individuals was 64%. At the time, we were at around 55%. Then we slashed rates in 1986. And we remain below the OECD average for just about 3 decades, up until 2013. In 2013, the Bush tax cuts for high earners expired, and since then, the United States has had a higher top personal rate than the average for OECD countries. With state taxes, we're at around 46% now for individuals, and the average in the OECD is 43%. The United States is actually a punishing country for high earners. An OECD country a number of years ago found that the United States has the most progressive tax system amongst all their member countries. I don't think that's a good thing. The top 10% in the United States pay 45% of all income and Social Security taxes. So 45%, the average in the OECD is just 32%. So for a country that's supposed to be a haven for entrepreneurship and opportunity, I think our punishing taxation at the high end is really bad economics. So let me talk a few minutes about the GOP framework. Alex touched on the business provisions. For individuals, the main thrust is to drop our current 7 tax brackets down to 3 lower tax brackets. That's good stuff. The Republicans would also double the standard deduction and increase the child tax credit. Those provisions won't do anything for growth because they don't change an individual worker's sort of marginal behavior to increase their work effort. It is true, though, that doubling the standard deduction would be a big simplification. I'm disappointed that capital gains tax cuts are not included in the Republican framework. I think capital gains tax cuts would play a unique role in entrepreneurship and investment in startup companies. Nearly all OECD countries have substantially lower capital gains tax rates. Our rate with state taxes is around 28%. The average in the OECD on capital gains, remarkably, is around 16%. So I hope, like Grover says, that Republicans will come back in future years and tackle the capital gains tax problem. Let me talk for a few minutes about distribution, or who gets the tax cuts. When the Republicans released their framework a few weeks ago, there was lots of discussion in the media and by lots of pundits that these are tax cuts for the rich. The Urban Institute's Tax Policy Center analyzed the Republican plan, and their results seem to show that it favored high earners. Tax Policy Center, they do have top-notch analysts over there. They're skilled economists, but I do think they slant the results in a liberal direction, and I'll give you an example of that. Their results for the Republican plan show that middle earners would get an average tax cut of $660. High earners would get a much bigger tax cut of $8,400. But the Tax Policy Center did not show how much those two groups were currently paying in tax. So I looked at those numbers and I found that the $8,400 tax cut for a high earners would be a 12% cut, but the $660 cut for middle earners would be a much bigger 20% cut. So TPC didn't show this in their results, but their underlying analysis shows that the middle earners would get bigger percentage tax cuts. Another problem with the TPC results is that, they're modeling. They use static models, and that, static and dynamic scoring has got a lot of discussion in recent years because it affects the overall sort of revenue estimates for tax bills. But the dynamic scoring versus static scoring is also very important to distribution tables. The TPC distribution tables, I think, were biased in a way that showed that high earners would do better than they actually would because they were static tables. Another issue is the allocation of the corporate tax burden. Alex touched on this. The Tax Policy Center assumes that most of the corporate tax burden falls on shareholders, which again would show that the Republican plan mainly benefits high earners. But the reality is, in the long run, most conservative economists think that the corporate tax burden lands on workers. So if you cut corporate tax rates, in the long run, it's going to be workers who are the main beneficiaries of that. So my point here is just to be very cautious about these studies and what news stories are saying about who benefits from tax cuts. Those questions are actually really complicated. So to conclude, having just discussed distribution tables, I don't think Republicans should focus on distribution. I think they ought to leave those issues of class warfare to the other party. I think Republicans ought to focus on how tax reform will create broad-based prosperity that benefits everyone. Liberals have suggested we don't need a tax cut now because the economy is doing pretty well right now. But the purpose of tax reforms is long-term economic growth. In the short run, economist Larry Lindsay noted in the Wall Street Journal the other day, quote, "When a supply-side tax bill like this is passed at a time of full employment, labor's share of the economic pie expands rapidly," unquote. Because labor markets are fairly tight right now, Lindsay expects substantial real wage growth if Congress passes a supply-side tax cut. So to sum up, supply-side or pro-growth tax reform would generate more business investment, more job opportunities, and higher wages in the long run. In my view, the Republican tax plan so far would advance those goals, and I think in the long run benefit every American. The challenge now, I think, going ahead is that the Republicans retain the most pro-growth or supply-side elements of their plan and that they don't get watered down as this tax bill moves through Congress. So again, thanks for being here. I'm going to give the podium to Ryan, who's going to take your questions. Thank you.
Well, thank you very much to all three of you. Very optimistic analysis so far today. We're now open for 10 minutes or so for questions from the floor. Before you ask your question, if you could just say who you are, and then as a kind of nagging thing from me, try to keep the question as pithy as possible so that we can fit as many in. Yes, lady at the front.
Sharon Novak, voice of a moderate. I'm really concerned about the people that voted to get Donald Trump into office. They are the people in the 25% tax bracket, the people whose taxes would go to hire people to do cleaning, to do yard work. And when we talk about the situation, we have to look at the elections in 2018. I would like to ask the panel if they would agree that giving the middle class a tax break is the most important thing, because granted, the corporate tax is an issue, but if you want to keep Republicans in their seats in 2018, don't you believe that the people that voted for Donald Trump should be respected?
The biggest winners of this tax package are the people who don't have a job today and didn't have one during the Obama years and get one because we have economic growth. Those people go from zero to a wage, okay? You can talk to other people that get $4,000 per family or $1,800 per family, something like that, in increased wages. That's good, but that's not as big a deal as the guy who used to have a job, used to not have a job, and now does. And that's where the damage that was done by the high tax rates that we put on. I mean, we're at 35. Socialist China is at 25, okay? And then we wonder why we don't compete, and then we blame the Chinese, like they wrote our tax code for us. We did that to ourselves. And stop damaging yourself is step one, and that's where, again, the biggest winners are the people who don't have jobs, who are just coming into the labor force and weren't going to get jobs or have been waiting outside or who quit looking. I mean, I don't think the economy is doing well today. I'm tired of hearing this from people. If you look at the number of people who quit looking for work, this is very depressing. I mean, 3% briefly, you know, it is not heroic. It used to be a little less than normal. So we need a much stronger economy. The biggest beneficiary is the guy who's going to get a job, and the Trump voters are the people who are that person or married to that person or sons and daughters or parents of that person. That's the biggest political win. When people see that, that's when the Republicans pick up 5 Senate seats in November and hold the House, and then we get back to some really serious tax cutting after that election. This is sort of an hors d'oeuvre.
Yeah, I think it's worth noting as well that broadly with all kind of policy issues, you've got to make a distinction between policies that are kind of popular in surveys and, you know, when people analyse these very static tables and figure out whether they're going to be a winner or loser directly. So policies that might not be popular but whose results might be incredibly popular. And I think if you had robust growth with the corporate tax cuts feeding through into wage growth as well, I think people would consider all of that in the round come the next election rather than just thinking about the debates that we're having as these bills go through Congress. Guy at the front.
Hi, I'm the guy at the front. Shelley, tax notes. Grover, this one's for you. You're optimistic that the current Republican tax reform bill will become law. Why do you think that?
Well, several things. This has been in the works for 3 years. Every once in a while, some reporter seems to think that we started writing it, you know, a month ago. The House and Senate has been coordinating for months now. The House, Senate, and White House leadership have been talking daily for at least 6 months. So this is pre-negotiated. You saw how seamlessly we had the House pass the budget, and there were a whole bunch of people who wanted to not vote for the budget for all sorts of different reasons, and they held their breath and did in the House, and then in the Senate, and then the Senate said, hey, House, what would you like different? And the House said, we need these things. So they amended theirs, the NZ amendment, right? This is an incredible amount of and quality of House-Senate coordination in working together to get this thing done. Then it went back to the House, and they just had to vote for the measure that they sort of pre-negotiated. So we're seeing them work. It's not quite Fred Astaire and Ginger Rogers, but it's close in terms of the House and the Senate working together. So in each of these things, and you're also asking people to vote for a tax cut, okay? This does not have a lot this is not 25, the House, I'm sorry, it's two-dimensional, right? Up, down. Or is that one-dimensional? Anyway, it's not a lot of moving parts. It's not three-dimensional chess. It's not healthcare, okay? There isn't some huge financial interest like insurance companies or hospitals or pharmaceuticals all fighting against your reforms because they're all paid off to do the Obamacare reform, and undoing that, you know, they had already made their deal. We don't have that in the same way on tax reform. You are cutting just about everybody's overall taxes down. It's an easier sell. Republicans know how to cut taxes. They may invade small countries they can't pronounce, but they will cut your taxes.
I would also add to that I see an unusual unification of purpose on the business side. I mean, for years in Washington, I've always lamented that these corporate lobbyists would come up here to Capitol Hill and they'd fight for their narrow little thing and they wouldn't worry about overall reform. I've seen so many corporate CEOs on CNN and CNBC, et cetera, the last few years, all pushing for overall broad reform. They really are unified, so I think it's a really impressive show of strong support in the business community, small and big businesses. So, hope that unity stays together, and I think it will.
I've talked to a bunch of business guys who go, don't tell anyone, but we don't really mind about this, this, and this. If we get the rates down, the number of things they don't care about that if the rates weren't part of it, they would care deeply about. Bringing the rates down, and including subchapter S guys, the pastors, really unifies the business community. And I haven't met any of them who go, oh, we don't really care about the rates. They all care deeply about the rates.
Okay, next question, guy in the maroon shirt over there.
Sure. There has been no mention about the national debt in this conversation, and with debt rising by $20,000 every second, and with national debt hitting $20 trillion in September, how important is fiscal responsibility to you?
Alex, do you want to comment on that distinction?
Sure. I worry about our long-run fiscal outlook. I think what we all should. I think that we need to think about getting our books in balance. I would also say that in the context of tax reform, we should distinguish between what the 10-year budget number is in tax policy, which is the only number anyone ever talks about, and what the long-term budget consequences are of tax reform. I've said before, I've written this before and testified about this, that I think it's very reasonable to be both concerned about the long-run fiscal outlook and to recognize that there are costs associated with transitioning from the tax code we have to the tax code we want, right? And so, there are a lot of reforms that will, have relatively small positive revenue impacts in the near term, but might have large revenue impacts outside the budget window. There might be a desire to sort of front load the tax cuts for political reasons or other reasons. And so might be a mismatch within the budget window. And so I think that we have this framework that we're not going to change it from the way the Budget Act of '74 prescribes that the policymakers look at tax policy. But I think that it's totally reasonable to say that we need to deficit finance the transition from tax reform. That said, I think we also need to be cognizant about what the long-run budgetary consequences will be of tax reform, but we need to do that recognizing the dynamic nature of tax policy and fiscal policy generally. And so we need to use dynamic models and think about how we might be better off as a result of tax reform. We're not going to be better off in the next day after tax reform. The economy's not going to be bigger. It takes time to make that adjustment. Once that adjustment occurs, we have a broader tax base, and other reforms that are in the code start to take effect. I think we won't face the same. We may not, depends on the details, right? We may not necessarily face the same long-run budget consequences of tax policy that we see within the budget agreement within 10 years.
The deficit is an uninteresting and unimportant number that is the difference between two very interesting and important numbers. How much the government spends is the deadweight cost of government. And whether they borrow it or steal it to make that number, it's total spending that's the deadweight cost of government that comes out of the productive economy and goes to the government. How much the government takes in taxes and how they do it, that's important too. The how can be more destructive than less destructive, and part of tax reform is being less destructive of economic growth and jobs and opportunity while still raising revenue. So when people focus on the deficit, it's because Republicans back in the 50s said, we're against deficit spending. They said deficit spending because they didn't think anyone would care about spending. So I said deficit spending, so all the Methodists would oppose it. And they would say debt, debt, debt. It's the total spending that's the problem. My professor at Harvard said this deficit spending is a stupid concept. It's just those conservatives getting in the way of spending. Okay? He saw the use of deficit as an anti-spending thing, and he was left of center, very pro-government spending. Thought it was an excuse. Conservatives, free market people, limited government people who say deficit spending make a mistake. They should be talking about spending, not just deficit spending. Raising taxes to pay for big government doesn't make big government go away. It just encourages them. Then they'll spend more because they're, oh, we got them to raise taxes. We'll do more. Our friends on the left who don't mind deficits when we're doing Obama stimulus or Obamacare or in creating new entitlement programs, but then all of a sudden when there are tax cuts, they're against deficits. That's why the fellow the third-party candidate against Bush, Ross Perot goes, the Republicans are against deficits, we're against deficit spending, and the Democrats are against deficits, they're against tax cuts. They're all agreeing, but they can't do it. They weren't agreeing. They were using the word deficit to mean two different things. Democrats say deficit when they say raise taxes. Republicans say deficit when they mean cut spending. And we should be clear about what we're doing. And yes, long run, we want to not be adding to deficit and debt because we want to be spending less, and we want the economy growing so much that there's plenty of revenue. So the deficit can be a shiny thing that people use to distract, and it makes it difficult to have a conversation when liberals say deficit when they mean we want to tax you more, and Republicans say deficit, we want to cut spending, and the poor person watching TV at home goes, I don't understand why they can't agree.
I would say that, the deficits are usually an important issue. It is immoral and unethical to be throwing all this cost of government spending, as Grover said, onto future generations. That's why I think in this tax bill it is very, very important to make sure that the vast majority of reforms and cuts are pro-growth or supply side so that the economy will expand in the long run, the government will get a reflow of revenue. If you have something like an expansion in child tax credit, I get why politicians want to do that for political reasons, but let's say it causes a $50 billion a year, government revenue loss. That loss will stay in the long term. If you take the $50 billion, cut the corporate tax rate, or do some sort of other supply side reform, as Alex said, it'll mean the corporations, they'll report more income to the U.S. government. There'll be this big reflow of revenues back into the United States. The government would be a winner in the long run. So the Republicans, I really hope they keep focused on pro-growth tax reforms and not just sort of tax cuts that are sort of short-term giveaways.
Okay, I think we've got time for one more question. So who would like to? Yep, the guy in the blue shirt.
So I know, Alex, you touched on they're broadening the tax base, and also Grover, in one of the questions you also talked about people who don't have jobs being the real beneficiaries. I'm wondering how confident you are in this bill that those tax cuts will be offset by these new jobs and broadening of the tax base, and also if you know if there's an industry that will benefit more from these tax cuts or where the jobs will be coming from.
For stock tips.
Yeah. I'm optimistic. I mean, we haven't seen the plan. I think we'll see the plan at the beginning of November. The details of the plan more than the broad outlines. I'm very optimistic. We across industries, I would say that different industries face different tax burdens. Retailers tend to pay a lot. Guys who can shift their income abroad, their intellectual capital abroad, tend to pay a lot less. And so tax reform should sort of even out that burden, industry by industry. I agree. If you don't have a job, getting a job is the greatest thing. And to the extent that happens, that'll be great. We do have low unemployment at the moment, and a low unemployment rate, but we also have a lot of people who are out of the labor market. I don't know if those people will re-enter the labor market if the opportunities for them are great enough. But I hope so, and I think that they may. I mean, we have other pressures on the system besides tax policy, but I think there's an opportunity for more people to be working in the United States if the returns from working are high enough, and that's going to mean more things happening here in the United States. So again, it's not like it's the single silver bullet here. People have to have skills. People have to want to work, but I think that generally people do want to work, and many people have skills. Not everyone has the skills they need in this economy, but there are other things we need to work on. But I do think, again, not the day of the bill signing, not the next week, not the next month, but I do think that the tax reform along the lines of what's being discussed is more likely than not to lead to more investment in the United States and more employment.
Brady just announced he's going to show everybody the thing on November 1st. So they'll start the committee hearing, and they'll have a bill to work off of, which is pretty good and impressive. I think one of the big beneficiaries is that the politics of the United States is going to get easier and nicer with strong economic growth. When you have lousy economic growth, in the last 8 years, with 2% growth, it's the weakest recovery we've had in modern history, and everyone's grumpy because they don't have jobs and they're not able to move, and and people have been leaving the labor force during a recovery. The labor force participation has been going down. That's not what's supposed to happen in a recovery. It's supposed to go up. And U6, which takes into account people who aren't looking anymore because they've given up, is still an ugly number. It's not a good number. And if we get the growth that I think that we should get from this, that we saw out of the Reagan years. Again, Reagan, I know you guys are all too young to remember this, but when Reagan cut taxes in '83, January '83, about 4 million jobs were created that year, 1 million in October. That was an economy 2/3 the size of ours, or a labor force 2/3 the size. It'd be 6 million jobs created in 1 year to have the kind of growth that you had coming out of Reagan's years, which included deregulation changes, but the Trump administration has been doing some very helpful things on deregulation as well. I think that's going to be the untold story. 50 years from now, when we look back, I think people will say the tax cut was really big and deregulation was a large part of the growth that flowed from that. Why do people get grumpy about international trade and immigrants? They do so when there's lousy economic growth, and then they think they don't have a job because an immigrant took it or somebody sold us something inexpensively, the rat. How could they do that to us? When we have strong economic growth, people are cheerful about international trade because they see themselves as beneficiaries of it, both as consumers and as workers exporting stuff. And the immigrant is not somebody who took your job, because I have a job and my brother has a job. So it just makes for a much less grumpy electorate. And I think you'll see not just economic benefits, but everyone will smile more.
Well, I'm afraid that's all we've got time for, but I hope you leave this room smiling today. Just before you head off, I'd just like to thank Alex, Grover, and Chris. If you could all join me in giving them the usual applause. Thank you. Before we leave, I think we've got one quick announcement from Peter.
Yes, for those of you who have tax as well as healthcare in your portfolios, we'll be doing an event around here. It might be this room or the next one over on November 15th, which is a Wednesday, called Liberating Telemedicine. And we will have Shirley Sforny and Michael Cannon will be participating in that one. So hope to see you soon. Thank you.
Thanks a lot. Great stuff.